Okay, looks like we're live. Had a little bit of a false start there for just a moment, but it's just as well because it turned out I didn't even have the correct title on the stream for the right company, so whatever. But either way, for anybody that didn't notice that, we're live. Welcome to Live Valuation. I'm Midas Moriarty, and today we're going to be covering ticker PPL, PPL Corporation, Pennsylvania Power and Lights Utility Company. Regulated utility, now a primarily U.S. focused regulated utility after previously being a little bit of a combination of U.S. and U.K. regulation. They recently divested their U.K. business, and they're working on finishing up an acquisition here in the United States to sort of replace those revenues. Though in the interim, they're without those revenues. Though that deal is expected to close probably within this next quarter or so, or the second quarter at the latest, due to some regulatory stuff. But we'll kind of get into that. Just kind of looking here at our initial schedule on our watch list. It is obviously a bank holiday today, so the market is not open. So there hasn't been any changeover since the last valuation that we did on Saturday. But I do think that I'm probably going to start a position in Facebook Tuesday. Small, probably going to keep it relatively small in general, just on the premise that I do think it's a good valuation, but I do think it could linger for a while as well. And if I'm wrong and it goes up quickly, well, that's a better thing to be wrong than putting a huge amount in initially and then finding out the other way around. So either way, there's just kind of one comment I wanted to make on the watch list itself. As well as our little kind of schedule of companies. I haven't seen any other 10Ks come out other than this PPL one that we're going to do today. And then we've already discussed the fact that AT&T is already out, as well as the Jeffries one. So unless anything else comes out throughout the week, though I imagine at least one of these would come out throughout the week, then on Friday it is looking like it will probably be Jeffries. But whatever. Throughout the week, we are also expecting a few more economic data points to talk about. It'll be interesting, especially to talk about the GDP numbers come Friday. We'll definitely get into that, though there's a bunch of stuff kind of coming out throughout the week, but that'll be for Friday and Saturday to talk about. Getting into PPL, as I was saying, they recently divested their UK business and are replacing it with a chunk of business that they're purchasing from National Grid, Narragansett Electric, which will be, I think, a pretty decent addition. And it kind of comes down to kind of looking at the numbers and thinking about how much cost efficiencies can be made over the course of the time frame to kind of come up with what type of margins we think they'll have at the end of the day. Because right now they're taking a huge loss, so their current margins don't look great, and with the fact that they're losing so much revenues in the short run, it makes it hard to project the future margins. It is also worth noting that this deal comes with a decent amount of deleveraging, which is really good for their company, but that also just adds uncertainty to the overall mix. So we'll cover some of the prep work pieces that I typically do. One other thing I was going to cover is that they also recently cut their dividend, which was something that they had basically said that they would be doing, was rebasing their dividend once this deal went through. But naturally there was a decent amount of sell-off when that happened, even though it was all part of the plan in my opinion. And it really just sets them up to deleverage more in the future, which I think is good for their overall valuation, as we'll get into. But either way, that their current dividend now, I think it's still like 3%. When before it was like 5.5% to 6%. So if you ask me, that's still a pretty strong dividend, pretty much no matter how you spell it. So some of the prep work stuff that I typically get into. Actually, looks like I totally forgot to go grab the unlevered beta and sales capital ratio net margins for this. Luckily, it is just an utility, so it's really simple and I can do that really quickly. Normally I do that ahead of time because a lot of companies have complex segments that require me to do a lot of calculations on that, and I don't do that all through the stream because I try to keep the streams only to a certain length. But considering that's so short, I guess that's no big deal that I forgot to do that. Definitely had a lot of homework to do this weekend, so it's a little pressed for time. Thought I had already covered it. One moment. Okay, so we'll go ahead and grab those, which will only take a moment since it's just one number that we need for each category. Which, I mean, really we only need the unlevered beta. The other two numbers I just like to look at, and since it's all in one industry, it's not as important, though. Considering we have some uncertainties for the industry, it'll be nice to know what the current industry averages are at. So yeah, a general utility company unlevered beta, after with the way that I like to calculate it, gets me 0.61. And we'll take a look at their sales to capital ratio for the industry as well. All these data sets courtesy of Aswalk the Motoron, as I'm always generally plugging him. 0.35, yeah, terrible sales to capital ratio for the utility industry. Part of the reason that I'm invested in this company has to do with some expectations about like these deals that they're going through right now. There's follow-up deals I sort of have an interesting perspective on that I'm waiting out a certain period to see what happens, which we'll get into when I'm done with the numbers. But it's basically just a theory I picked up from other YouTubers about a potential further deal that could be done after they finish the UK deal, and that could have been basically just setting them up for an acquisition themselves, being acquired themselves. So I see them as an acquisition target essentially, and I'm holding them mostly for that optionality and the high dividend deal that they had before. I thought of as essentially the being paid as the opportunity cost while I waited, and which means it sucks that it got cut. But I also consider them close to the fruition of such a deal now that they've completed the UK deal. The acquisition of Narragansett was a unexpected aspect of the plan, and it could be an indication that the plan isn't actually to set themselves up for acquisition anymore, but I'm willing to wait out a couple quarters to see if not, because that doesn't make them so big that they could be acquired by the company in question. But either way, we will get into that. So there we go, we got that. 0.35 for the industry of utilities with 17.11% net margin, net adjusted margin as the industry average. This is all US, so it's pretty simple equity risk premium to use. They do have $11.4 billion of book listed debt at a weighted average maturity of 15 years and interest rate of 3.57%, and that is after including lease liabilities as per normal. They definitely have cut their debt pretty significantly over the course of the year, relative to some of the other valuations that I have that I've done with other companies that I've owned, where I try not to look at it too closely. In this case, I have been looking at it a little bit more closely, just because of the way that the deal is going through. I decided that I was going to suck it up and deal with the fact that I might be biasing myself by looking at my previous valuation, because I wanted to see some of the evolution of the numbers a little bit more closely. But anyway, they've cut their debt by basically half by either paying down some of it or just selling it off with the UK business itself. They went from $23.3 billion in debt to $11.4 billion of debt. It's now a weighted average maturity of 15 years, but the interest rate is now up to 3.57 when it was at 3.16. So a little bit higher interest rate, but it's a longer maturity profile and it's way less debt. And the good news is yeah, they cut a decent amount of their revenues, but they didn't lose half their market cap. So losing half their debt, even though they only lost a small chunk of their market cap, means that on net, their debt to equity ratio has improved dramatically from last year to this year, which will have a huge effect on our valuation, I think. But we'll see what that overall looks like. Like I said, we do have to project in the correct amount of revenues. You can see the sales to capital ratio for that year was 0.27, so it is a little bit low relative to the expectations, but that's to be expected relative to what they've been doing with most recent activities. Most recent margin, like I said, it's negative, so pretty rough in that category, but we will come up with our own kind of way of figuring out the numbers. So as normal, I already did 1 year of the numbers, and I will play the fourth quarter earnings call while I do the rest of them.
And welcome to the PPL Corporation fourth quarter earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note this event is being recorded. I would now like to turn the conference over to Andy Ludwig, Vice President of Investor Relations. Please go ahead.
Thank you. Good morning, everyone, and thank you for joining the PPL conference call on fourth quarter and full year 2021 financial results. We provided slides for this presentation in our earnings release issued this morning on the investor section of our website. Before we get started, I'll draw your attention to slide 2 and a brief cautionary statement. Our presentation and earnings release, which we will discuss during today's call, contain forward-looking statements about future operating results or other future events. Actual results may differ materially from these forward-looking statements. Please refer to the appendix of this presentation and PPL's SEC filings for a discussion of factors that could cause actual results to differ from the forward-looking statements. We will also refer to non-GAAP measures, including earnings from ongoing operations and adjusted gross margins on this call. For reconciliations to the comparable GAAP measures, please refer to the appendix. Participating on our call this morning are Vince Sorgi, PPL President and CEO, Joe Bergstein, Chief Financial Officer, and Greg Dudkin, Chief Operating Officer. With that, I'll now turn the call over to Vince.
Thank you, Andy, and good morning, everyone. We appreciate you joining us for our 2021 year-end earnings call. Moving to slide 3 in the agenda for today's call, I'll begin this morning with an overview of 2021 and what was clearly a significant transition year for PPL. I'll highlight key achievements we made throughout the year, including our progress in strategically repositioning PPL for future growth and success. Joe will provide a financial update, including the previously discussed reset of our first quarter dividend we announced this morning, and a detailed overview of our 2021 financial results. And as always, we'll leave ample time for your questions. Turning to slide 4, I'm incredibly proud of how our team performed in what was truly a remarkable year for PPL. As we began a new century in our company's history, we took bold steps to strategically reposition PPL as a U.S.-focused energy company committed to sustainable growth and well-positioned to lead the clean energy transition while maintaining affordability and reliability for our customers. We completed the sale of our UK utility business in June, achieving exceptional value at almost $11 billion while eliminating risks associated with foreign operations.
Technically, they took a loss, but
we then took steps
it was an
to
opportunity
strengthen PPL's
cost.
balance sheet by reducing $3.5
Good
billion
choice.
of our holding company debt, which provides us with significant financial flexibility going forward. We advanced our planned acquisition of Narragansett Electric, which will expand and diversify our U.S. presence, add another high-quality regulated utility to our portfolio, and create additional opportunities to leverage our proven operating model to drive value for customers and share owners. We anticipate receiving a final order from the Rhode Island Division of Public Utilities and Carriers with respect to the acquisition by March of 2022. While the strategic repositioning was a key priority in 2021 to set PPL up for long-term success, we also remained focused on achieving our near-term objectives. In 2021, we continued our track record of earning equity returns that were in line with those allowed by our regulators. We also achieved constructive regulatory outcomes in 2021, with the settlements on the Pennsylvania FERC ROE challenge and the rate case in Kentucky, which will provide added stability and predictability to our plan over the next several years.
I should have double checked that.
We
Cash
also
flow a few
returned over
times.
$2 billion to share owners through dividends, as well as share repurchases, which included the completion of our targeted $1 billion share buyback through December 31st. And true to our mission, we delivered energy safely, reliably, and affordably for our 2.5 million customers in the United States. And as the pandemic refused to yield, we stayed resilient acted responsibly to protect our employees, and remained focused on continuous improvement. From Kentucky to Pennsylvania, we delivered exceptional service throughout 2021. We maintained transmission and distribution reliability as well as generation availability that was among the best in the industry. Despite PPL Electric Utilities experiencing significant storms during 2021, it maintained top quartile performance for safety, which measures the average number of outages our customers experience. Meanwhile, our Kentucky operations posted their second best year on record for safety. When severe weather struck, either in Pennsylvania or Kentucky, we responded quickly and effectively. For example, after December tornadoes tore through portions of our service territory in Kentucky, damaging or destroying more than 500 transmission and distribution poles, we restored power to most customers within 48 hours. Similarly, when the remnants of Hurricane Ida swept through our Pennsylvania service territory, knocking out power to tens of thousands of customers, we mobilized quickly and effectively to get the lights back on as soon as possible. Our restoration performance in the wake of Hurricane Ida was recognized with an EEI Emergency Response Award. This performance is the result of the investments we've made in our grid and our dedicated employees who pride themselves on delivering this superior level of service each day. And that service was once again reflected in our customer satisfaction scores. We were honored to receive 4 new J.D. Power Awards in 2021 for electric utility residential and business customer satisfaction, with PPL Electric Utilities and Kentucky Utilities both ranking highest among similarly sized utilities in their respective regions. And following an independent survey of customers at 140 of the largest utilities in the U.S., PPL Electric and Kentucky Utilities were recognized by Escalent as 2 of the most trusted utility brands in the nation. Across PPL, we also continue to foster a culture of innovation, investing in advanced technology and data analytics to deliver industry-leading reliability and enterprise-wide cost efficiency. This resulted in multiple industry awards in 2021, including the use of dynamic line rating technology and the use of data analytics to better target vegetation management. With an eye toward keeping reliability strong and empowering our customers, we also continue to invest in the future. This included executing more than $2 billion in infrastructure improvement to further strengthen grid resilience, modernize our network, incorporate advanced technology, and pave the way for increased electrification and renewable energy in our service territory. Turning to slide 5. Over the past year, we also delivered on our commitments to deliver a sustainable PPL for our shareowners, employees, and the communities we serve. We made significant progress in advancing our clean energy strategy. We adopted a net zero carbon emissions goal, accelerated our interim emissions reduction target to 70% from 2010 levels by 2035 and 80% by 2040, and we also accelerated our coal plant retirement schedule. Separately, we announced the commitment of over $50 million in new investment to fund research and development in the clean energy space with our planned investments in EIP and every Low Carbon Resources Initiative. We also launched a new partnership to study carbon capture at natural gas combined cycle power plants and reached new agreements to provide an additional 125 megawatts of solar power to major Kentucky customers. In November, we published our latest comprehensive climate assessment report, which highlights the risks associated with climate change and the opportunities in responding to it, and evaluates potential future emissions under multiple scenarios. This included a scenario consistent with limiting global warming to 1.5 degrees Celsius. Our climate assessment outlines our clean energy strategy and goals to enable a responsible transition that balances our commitment to the environment, our customers, our employees, and our community. LG&E and KU also submitted their triennial Joint Integrated Resource Plan, which reflected a significant increase in projected renewable additions in the 15-year planning horizon compared to our prior plan. We expect the trend of a more rapid decarbonization of our generation fleet in Kentucky to continue, with further improvements in cost and technology for renewables, as well as other clean energy technology. In addition to our focus on advancing our clean energy transition, we also remained very engaged in the communities we serve and with our employees throughout 2021. We continue to move PPL forward by creating a more diverse and inclusive workplace. We implemented an
Did
enterprise-wide
that one
diversity,
accidentally.
equity, and inclusion strategy, adopted DEI commitments, increased diversity within our leadership rank, overall workforce, and the board, and we expanded our support for social justice and equity initiatives in the communities we serve. In addition, we continue to create new opportunities through business resource groups for employees of all backgrounds and experiences to collaborate, share perspectives, and contribute to PPL's success. Our strong commitment to diversity and inclusion received recognition from multiple organizations in 2021, with PPL being named the best place to work for LGBTQ equality and disability inclusion, as well as a top company for ESG. And this January, PPL once again was named the best place to work for LGBTQ equality, marking the 6th straight year PPL has received this recognition.
Yeah, see, I doubt they're going to be able to achieve 20% net margins.
PPL employees and retirees collectively.
Which is part of the reason there's been some decline in stock.
More than $7 million
we'll see.
in individual pledges and corporate
we'll see what we come up with.
That will help lift individuals, families, and communities.
20% feels like it's going to be a lot.
In the aftermath of the Kentucky tornadoes, we responded quickly, providing financial support to assist Kentucky families and businesses.
I have a feeling 10% could be enough for them.
So we continue to build an exceptional management team that we believe will lead PPL to its best years to come. We promoted Greg Dudkin to Chief Operating Officer and are leveraging his experience in building one of the most advanced utilities in the nation in PPL Electric Utilities to drive further value for stakeholders across all of PPL's operating companies. We're extremely excited to have Wendy Stark on our team as our new General Counsel. Wendy's extensive experience in regulatory matters and her deep knowledge of our industry have made her a great addition to PPL. We named 2 new utility presidents in Pennsylvania and Kentucky, with Stephanie Raymond in Pennsylvania and John Crockett in Kentucky. Stephanie is the first female utility president in our company's 100-year history. We also named a highly qualified and experienced leadership team in Rhode Island, led by Dave Bonenberger from PPL and numerous talented employees from National Grid to lead our electric and gas operations pending the completion of the acquisition. We also took steps to strengthen our corporate governance during the year. Our board of directors appointed an outstanding leader and experienced board member as independent board chair in Craig Rogerson, reflecting PPL's continued commitment to strong corporate governance and independent oversight by a diverse, engaged board. And Heather Redmond, co-founder and managing partner of Flying Fish Partners, was a welcomed addition to our highly experienced board of directors and brings a wealth of expertise in disruptive technologies and the energy industry. In summary, across our business, we made tremendous progress in 2021 as we pursued our strategy to deliver sustainable value for all stakeholders and position PPL for future growth and success. With that, I'll now turn the call over to Joe for the financial update. Joe?
Thank you, Vince, and good morning, everyone. Let's turn to slide 7 for the financial update. Today, we announced fourth quarter reported earnings of 18 cents per share. Special items in the fourth quarter were 4 cents per share, primarily due to integration expenses associated with the planned acquisition of Narragansett Electric and discontinued operations associated with the UK utility business. Adjusting for special items, fourth quarter earnings from ongoing operations were 22 cents per share. Our fourth quarter results bring our total 2021 results to a net loss of $1.93 per share. Special items for 2021 were $2.98 per share, primarily due to discontinued operations associated with the UK utility business, a UK tax rate change prior to the sale, and a loss on the early extinguishment of debt.
Yeah, so we're going to be able to save on some taxes in the future.
For special items,
that's one thing that I think we'll be able to count on.
$1.05 per share. Before turning to the 2021 earnings walk, I'll highlight a few other financial updates.
We should be able to cut some operational expenses, a decent amount of taxes, certain interest expenses, certain depreciation expenses.
We plan to update the dividend following the January third payment as we
going to take a look
continue
at
to progress on PPL's strategic repositioning. Recall that we had maintained the dividend at the prior rate despite the sale of WPD, providing $350 million dividends to reward long-term share owners as we work to close the transactions and deploy the cash proceeds from the WPD sale in a value-accretive manner. Today, we've announced the first quarter 2022 dividend of 20 cents per share, payable April 1st.
I think it's good to have brought
The
their
updated quarterly
payout
dividend
ratio down
aligns with
like
our
that.
earnings projections
Personally.
for PPL's current businesses and its targeted
Yeah, it's going
payout
to lose a
ratio of
certain
60 to
investor base,
65%.
but
We plan to provide an updated annualized dividend rate and growth projections that align with earnings growth during an investor day following the completion of the Narragansett regulatory review process. We recognize that it would have been optimal to declare the April 1st dividend when we provide our annualized earnings forecast. However, since we haven't completed the Narragansett regulatory review process, we wanted to be transparent today by providing clarity on the dividend reset following the sale of WPD. We plan to reflect any increase in the dividend due to the inclusion of Narragansett in our forecast when we provide a comprehensive financial update at the Investor Day. As Vince noted, one of the key financial highlights for 2021 was a reduction in our holding company debt as we allocated a significant amount of the WPD sales proceeds
no, taxes are in the
PPL's
payables.
balance sheet. We had a unique opportunity to establish one of the leading credit profiles in the sector, an attribute we see as increasingly important with the growing capital needs to fund the clean energy transition and now amid the backdrop of rising interest rates. In other financial updates, we amended and extended our credit facilities during the fourth quarter to better align our liquidity needs post the strategic repositioning. In short, we slightly reduced the capacity at PPL Capital Funding to $1.25 billion from $1.45 billion as we no longer need the same level of liquidity without the foreign currency risk associated with the UK. We have also included an option to add Narragansett as a co-borrower to the PPL Capital Funding credit facility pending the closing of the acquisition. And we continue to target 16 to 18% CFO and FFO to debt metrics, including the Narragansett Electric acquisition. We believe these actions provide a very strong financial foundation and place PPL among the best credit profiles in our industry. Let's move to our full year 2021 earnings
whoops,
results.
This cash flow statement, my bad.
I would note that while I will compare 2021 earnings to our 2020 results, the periods are not truly comparable given the sale of the UK businesses, the reallocation of certain costs, the balance sheet recapitalization, along with the outcome of the transmission ROE challenge. Similar to prior quarters, we have adjusted the 2020 corporate and other amount to reflect certain costs previously allocated to the UK regulated segment, primarily interest expense and other support costs. These costs total about 7 cents per share for the year. Turning to the ongoing segment drivers, our Pennsylvania regulated segment earned 61 cents per share, a 4-cent year-over-year decrease. Earnings results in Pennsylvania were primarily driven by a reduction in the transmission formula rate return on equity, lower peak transmission demand, and higher operation and maintenance expense.
Yeah, you can see the decline in the EPS.
These decreases were partially offset by returns on additional
hope that maybe it
capital
sticks the
investment.
baseline around 2 or something. We'll see
Turning to
what
our
we come up
Kentucky
with.
segment, we earned 61 cents per share in 2021, a 6-cent increase over comparable results 1 year ago. The increase was primarily due to higher.
This is why I did look
retail
at my
rates
previous valuation a bit
July
more this
1st.
time. I actually did like as many
Lower
adjustments to my
interest
old valuation as
primarily due to
possible based
lower
off of
interest costs that were
the third
previously
quarter
allocated
data,
to the Kentucky regulated segment,
trying to like fit and
lower
think
interest
about
rates.
what could
Partially
happen with the
offsetting
deal.
these items were higher operation and maintenance expense.
And I
related to
felt that
several
the stock,
factors,
based off of my
including
old
support
valuation,
costs,
was
generation
basically
plant
fair
costs,
value currently.
T&D costs,
So,
and higher depreciation due to the additions to PP&E.
and that's after adjusting for the time differential. So we'll see if it's the same or not.
3 cents higher compared to the prior year.
Different capital
Factors
base.
driving earnings results at corporate and other primarily included lower interest expense, primarily due to less outstanding long-term holding company debt, partially offset by interest costs previously allocated to the Kentucky segment. Partially offsetting this increase were several factors that were not individually significant. Moving to slide 9, the capital investments made in Pennsylvania and Kentucky during 2021 supported grid modernization, grid resiliency and reliability, and improved service for our customers. Of the $2 billion of CapEx that Vince noted, we invested about $1 billion in each of the segments. In Pennsylvania, investments in distribution were made to maintain top quartile industry reliability and performance, and investments in more advanced IT systems. Meanwhile, on the transmission side, investments were primarily related to asset health and reliability, with a focus on smart relays, equipment monitoring, and automation to support a more advanced grid. Our Kentucky investments were primarily related to replacing aging transmission infrastructure, maintaining and enhancing our electric distribution network, generation outages, environmental compliance, and grid modernization. This resulted in total rate base growth of nearly 6%, even as rate base related to our coal-fired generation facilities declined. That concludes my prepared remarks, and I'll turn the call back over to Vince for some closing comments.
Thank you, Joe. As I mentioned at the outset of my remarks, 2021 was very much a transition year for PPL. It was about reimagining PPL and laying a firm foundation for the company's future growth and success. And I believe we achieved just that. Looking forward, our focus is on completing the acquisition of Narragansett Electric and introducing a new PPL to share owners. A PPL that is committed to delivering sustainable value for share owners, backed by one of the strongest balance sheets in the U.S. utility sector, distinguished by its best-in-class customer service, committed to net zero carbon emissions, and well-positioned to lead the clean energy transition while maintaining affordable, reliable service for our customers. We look forward to sharing further details on our strategy and the exciting growth prospects for the new PPL at our Investor Day.
With that, operator, let's open the call for Q&A.
We will now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. At this time, we will pause momentarily to assemble our roster. And our first question will come from Shar Dorazia of Guggenheim Partners. Please go ahead.
Hey, good morning, guys.
Morning, Shar.
So Vince, perhaps, if we can just start on the process in Rhode Island. It seems like there's been some noise around things like cost and mutual assistance versus grid's ownership in the docket. Any kind of color you can provide around your interactions as the decision target date approaches by the end of this month?
Yeah, sure. First of all, let me just say that, we think we've met the standard for approval in the state, and we are looking forward to the decision coming out from the division. And again, as we've stated,
Yeah, it seems unlikely that they're going to say no.
This process, we believe
I'll get into that in a minute, but
uniquely positioned to serve Rhode Island customers at this point in time. When you look at our long history of providing energy safely, reliably, affordably for our customers, we consistently rank among the very best for customer satisfaction. We've been a clear leader in developing and deploying the kind of smart grid technology that's going to be critical to helping Rhode Island meet their very ambitious decarbonization goals. And with the additional commitments that we've made, we believe the transaction is clearly in the public interest in Rhode Island. So, I'll just reiterate that we believe we've met the standard, and we're looking forward to the decision.
Got it. So I get it. So just there is a high level of confidence that we're going to close. Okay. And then just Vince, you completed the $1 billion buybacks, right? Increased CapEx by $1 billion at EEI. Could we just check back in on the remaining amount of unallocated cash here and how you're thinking about the toggle allocation between buybacks?
There's like another $2 billion or something
in light of the current DPS guidance.
Yeah, Shar, I would say we don't have a detailed update on that. We'll provide a full update at the Investor Day. Really, it's important that I think we get through the regulatory process in Rhode Island. Of course, we've made some commitments as part of the process. Today, we want to make sure we factor all of that into the proceeds discussion, and we'll update that with the full update on the Investor Day call.
Got it. Understood. And then just on a little bit more of a minor thing, is maybe just can you comment on the
Gotta see how much
Safari
it
sale
costs
process?
first.
I mean, it seems like there was some interest there previously. I guess what drove the decision to put it on the block, and any material amount of cash expected there?
Well, Shar, as you know, we're not going to comment on market rumors. So,
Okay. Try to get it past you, Vince, but you're too good. All right. Thanks, guys. Appreciate it.
Wouldn't be doing my job if I didn't try.
The next question comes from Paul Zimbardo of Bank of America. Please go ahead.
hey,
Hi,
Paul.
good morning.
Morning.
I know you commented a little bit on it, Joe, but just on the decision around the dividend and the timing now versus maybe wait until you have clarity in a month or so. Just any perspective there, and it sounds like the plan would be more of a kind of a one-time bump, assuming Narragansett closes, versus a faster growth rate on the dividend. But just any perspective you can provide there would be helpful.
Yeah, sure, Paul. You know, while it's certainly possible that we'll receive the decision as early as next week from the division, we're not certain of that. And you know, we are still in the middle of the regulatory approval process. And as we discussed on the third quarter call, we did want to reduce the uncertainty related to the anticipated reset of the dividend following the UK sale. And just without the firm timeline for the Rhode Island transaction, we just felt it was appropriate to keep our normal cadence, which, as you know, we would normally announce our first quarter dividend on our call, on our year-end call. And so as we were contemplating whether to move from that normal cadence and potentially hold off to the fall, we also realized that if we didn't do it today, we actually ended up doing it in an 8K, which would not be the preferred approach, of course. So we wanted to make sure that we could provide an opportunity for questions around the reset, and that was really the nature of the decision to announce it today.
Good choice. No fly-by-night dividend
And
cuts.
then in terms of
I mean, again, it was always part of the plan to cut the dividend, so
the
I don't know.
Q1 dividend is based on our current operations only, and we would
Cut the
plan
dividend
to
and then rebase it
increase that following the
once
close
they
of
know
the
what the
Narragansett
situation looks like.
transaction. And again, we'll provide that full update.
I say cut it and then leave it, personally. Just go with the higher growth rate.
Okay, great. And then one last question on the strategic corporate initiative costs you incurred in the quarter, particularly at Kentucky, as well as just the corporate overall. Just what's the thought process there, and is there anything you're considering specifically with that Kentucky property?
Uh-oh. What do I do there?
Yeah, no, I think the costs associated with the strategic repositioning.
Oh, hold on a second. My cat's outside.
Were normal in nature, related to the Narragansett acquisition. Really, the amount that's associated with Kentucky is really immaterial, and nothing related to nothing related to any strategic going on in Kentucky. It's all essentially for the Narragansett acquisition.
Okay, great. Thank you. Have a nice weekend.
Thanks.
Thanks, Paul.
The next question comes from Durgesh Chopra of Evercore ISI. Please go ahead.
Hey, team. Good morning. Thank you for taking my question. I know there's a good morning. Good morning, Vince. I know there's a update coming, post the Narragansett transaction. But just so we have the numbers right, am I right that with the share buybacks, and I'm focused on the leftover cash, with the share buybacks and the additional capex announced at the U.S. utilities, you still have roughly about $1 billion left to allocate. Do I have that number right?
Probably.
Well, I guess we'll get into the total use of proceeds and any and how that's utilized when we get to the investor day.
Yeah, I know where you're going with this question. I'm just going to cut you off right there.
And you may not be able to answer this also, but
I'm also going to cut him off right there because now we have our 5 years. So we'll go ahead and take a look at the 5-year historical trend. Going down to the sales to capital ratio, you can see that prior to 2020, their sales to capital ratio was pretty stable in this 0.22, 0.23 range, which is where they were at after their last divestiture of the main section of the business that they split off from. Then you can see that it had a dip in 2020, and then it's jumped pretty high up in 2021. That comes on the back of having decreased their debt pretty dramatically, even though that their sales have not, they still have most of the sales from the divestiture of last year, so they have a really relatively high amount of sales right here to their capital base that they have right here, though they are about to take on a decent amount more sales as they also increase the capital base. So hopefully this is an upward trend that can be sustained, if that is part of our thesis investing in them. So we'll get into that though. Looking further up, you can see that they've traded generally in the teens as far as P ratio. They've had their high moments of 2019, and like I said, right now they don't have earnings, so they're non-meaningful P at the moment. And then as they were just kind of talking about the debt levels, first we're going to start with the equity statement. You can see the equity statement is pretty stable, not really moving too dramatically. Same thing in the retained earnings. It's actually kind of come down a little bit with some of these capital structure movements on the whole of it. But you can see this dramatic drop in the total liabilities as of last year. So this deal really is a solid move in that direction, though it depends partially on the liabilities picked up with Narragansett. So we'll get into that as well. But on the back of that, as they were just talking about, they do have $3.5 billion still on the balance sheet right now, relative to their like $19 billion market cap, as well as the $11 billion debt pile or so. So with that, they have an enterprise value of in the range of, what is it, $27 billion. So pretty cheap as far as the overall market enterprise value compared to the market value on the net of it, is basically the point I'm trying to say. Like I said, we'll get into what it's going to look like after the Narragansett acquisition, which they're just saying they feel pretty confident about. That is a pretty high confidence thing to say. They don't have the regulatory authorities that have the opportunity to essentially make their beef with them to say no, have basically passed all of their opportunities up, save for this last one. So it'd be very surprising if they made zero qualms all the way up until the very last minute, and then the very last minute made a big fuss about it, when they really have had a very long time and many opportunities to complain if they were really trying to make an issue with it. So they're high confidence. I have that same high confidence, and you can see they have a huge cash flow equity in this most recent year on the past sale. Even though that was sold at a loss, it is a high cash flow number in this year. It's just going to come on the back of some low cash flow years, I think, back here from when they had made those acquisitions in the first place. But it probably will be a negative cash flow year in 2022, or a relatively low one after the acquisition. So that will balance it out as well. As I was saying, negative net margins here, but we can see they have pretty high margins, even in the 20 range after 2017. I think it's more likely to be in the 10 to 12 range after all this, but we'll see what numbers I do come up with. As they're talking about, they do have a share buyback program in place, so that's hopefully going to balance things out and bring the EPS back in the range. The hope is that maybe it can be north of $2 or something per share or something like that. I don't know. We'll see what we can come up with. So with that, I'll get back into the call and numbers.
I'll just ask, is the sort of 2022 going to be the base year for any long-term projections that you give out, or long-term earnings growth target that you give out?
Probably not. 23 is probably better.
Yes, that's the plan. Okay.
Okay, well, fuck me.
Okay. Thank you, guys. Appreciate the time.
Sure.
The next question comes from Paul Patterson of Glenrock Associates. Please go ahead.
Hello? Can you hear me?
Hey, Paul.
Yeah, we can, Paul.
So just to sort of follow up on this, how should we think of, I mean, I know you guys are obviously feeling confident about the Narragansett closure, but it doesn't appear that there's any settlement, and it appears that there's some uncertainty, just generically speaking, hence sort of the dividend action that you guys have been describing. How should we think about what the scenario would be if the deal doesn't come about, if you don't get approval for it?
Yeah, Paul, I don't really want to talk about some hypotheticals. We're really focused. Again, I'll just go back to what
it's probably like 95% certainty.
we think we've clearly met the standard for approval in the state.
If it doesn't, they can just do massive share buybacks
with what we
after the
bring
stock
to
plummets,
the
because the stock
table
will
in
probably
terms of
plummet
our
first.
operating experience, the financial strength of our company, of course, the commitments that we've made throughout the process.
So I would do anyway.
We and National Grid are very focused
Baby.
on getting to closing. We spent the last year on transition planning, integration planning, hiring or getting 1,100 people, identified and ready to start on day one. Paul, we are all very focused on getting this deal over the goal line and bringing real value to Rhode Island.
Okay, but given the idea that the target date, and again, I mean, are you hearing? Let me ask you this: are you hearing that there's any change in the target date decision? Because that's almost just a week away, and it would seem to me that with the dividend action and everything, that perhaps you could have sort of waited to do the earnings release and everything else, unless you think that there's maybe a potential that
They just want to rebase. Sometimes companies just give you some bullshit explanations for wanting to rebase.
About when we're going to get more clarity out.
I'm cool with it.
Is it
I don't worry about it.
Target date kind of thing, or is there something else?
I don't care how my returns get to me.
Yeah, look, Paul, I think based on the schedule that we have, right, the targeted decision date is the 25th. But we recognize that there's a lot in this case. Through the written testimony, the briefs, the oral hearings, we just want to recognize the fact that the 25th is a target, and there's a lot that the hearing officers need to get through. And so there's been no change in the 25th as the target, but we're just trying to be realistic that there's no guarantee that we're going to get it.
Okay. Thanks.
It's just an excuse. They just want to cut the dividend.
The next question
Too
comes
high of a
from Michael
dividend
Lapidus of
and destroy
Goldman
the
Sachs.
opportunity for future.
Please go ahead.
So,
Hey guys, thank you for
mind
taking my question. I actually want to just ask about Pennsylvania and Kentucky items. First, in Kentucky, can you remind us, as a result of the IRP, when the material fleet generation changes or transformation would likely play out over that extended time frame? What happens in the next 3 to 5 years? What happens in the years 6 through 15?
Sure. So we have the next round of retirements, you may recall, are in 2024. Based on our reserve margins, we don't anticipate a significant need to replace generation for those retirements. The next group would be in 2028. We would need to replace the 2028 retirements, and so probably see capital start to be spent in the 2026-ish timeframe for that, and then the next round of retirements are this side of 2035, so I'm thinking 2034, 35-ish, and so you'll see the capital in the early 30s to prepare for those retirements.
Got it. And given the move in commodity prices, both natural gas, power, and coal, do you see for the next couple of years your coal plants actually running at a higher capacity factor in Kentucky than maybe what you had seen previously? Or is there an opportunity to maybe save O&M and scale back the output levels of that source and either run gas units more or buy more power from the market?
Yeah, so it's a good question. We're
like that sigh as he starts talking.
We're incredibly focused on decarbonizing the overall generation fleet, but you bring up a good point around the cost of natural gas versus the cost of coal. So as we think about it, Michael, we'll continue to look at how we best utilize the fleet to ensure reliability for the lowest cost for customers, but at the same time, decarbonizing. So that could be the additional renewables through renewable PPAs or owned renewables. We're always looking at, does it make sense to shift between natural gas and coal. So those are all things that we continue to iterate as we look at the decarbonization, the overall decarbonization strategy for the coal fleet.
Got it. And then one last Kentucky question. Can you just remind me, I think I remember correctly, smart meter implementation in the company. It's been a while, but did Kentucky have a similar level of that relative to the other jurisdictions, meaning Pennsylvania?
Yeah, so we've done 2 rounds of smart meter deployment in Pennsylvania. We are doing our initial deployment in Kentucky. We're expecting that to be completed in 2026. And then you haven't asked, but in Rhode Island, they don't have smart meters, but that would be something we would be deploying very quickly after acquisition in Rhode Island as well.
Got it. Thank you, Ben. Much appreciated.
Sure.
The next question comes from Steve Fleischman of Wolfe Research. Please go ahead.
Thanks, appreciate it. Got a few questions, Vince. So I guess first of all, I thought you had said in the past that you were going to use like a pro forma base for your growth rate, you know, including like a full year of it, NEC, not just 2022. Is that correct, or are you going to use 2022 calendar year?
No, that's. Oh yeah, sorry if I wasn't clear on that with the earlier response. Yeah, it would be 2022's pro forma.
Okay. And just, you know, you have a new payout dividend, and you gave a payout ratio, so you can kind of back into what earnings power from the core businesses roughly are expected to be without NEC. Is that like a fair representation of 2022 core businesses, you know, without NEC?
That's reasonable, yeah.
Okay. And then just on NEC, I know initially the Attorney General had talked about being opposed. Have they given an official opposition now at the commission, or where does that stand?
Yeah, Steve, I don't think the Attorney General has modified their original position as we've gone through.
Okay, and so there's no, at this point, there's no like settlement talks going on. There's just going to be a decision.
At this point, we're just awaiting the decision from the division.
Okay. Okay, and then just on another thing you had talked about was potentially, I think you have potentially trying to kind of resolve future rate case as part of this too. But if you have to just get a decision, like when would be the next rate case in Rhode Island?
Yeah, so we've agreed to not file a rate case for a period of 3 years from the time of closing.
Okay.
And so then I think in Rhode Island it's 9-10 months to get from the time you file to the time you complete. So
that's where you get some of these lower cash flow years for starting to roll in.
Depending on when closes.
Which is some of the effects from the last acquisition. I think the biggest effect's going to be over here, though.
You know, at least your proposal, that's a condition of your filing.
Yeah, so that is a commitment that we made up front. So that is a commitment that has been made.
Okay. And then, so maybe just to sum up on the dividend. So you have this new dividend level based on the existing businesses. When you close NEC, you'll reset some payout, additional dividend related just to that business as well. And then beyond that, dividends would grow in line with earnings growth. Is that kind of the way to rebuild this up?
That's exactly correct.
Okay. Last question. Can you give any information on what Safari, had in terms of earnings or EBITDA and any debt on Safari, if there's any separate debt in 2021?
Yeah, so it's included in our corporate and other segment, Steve, and we don't break it out. from that. As part of that, it's really not material to the overall PPL Corporation earnings, and it's just not the level of detail that we provide given its materiality.
Is there any debt on it, or is it just part of PPL corporate debt?
Just PPL corporate.
Okay. All right. Thank you.
Thanks, Steve.
The next question comes from Ryan Levin of Citi. Please go ahead.
Good morning.
Morning, Ryan.
Something that you could elaborate on what factors drove where PPL wants to be in terms of dividend payout ratio relative to the range that you highlighted in your slide deck, and any color as to how you're thinking about that for a subsequent dividend decision.
Yeah, I'll let Joe cover the details, but just high level, right? We wanted to make sure, again, that this is a broader strategic repositioning, obviously starting with the sale of UK, acquisition of UK. The dividend reset was a natural part of that. And so making sure that, again, we have one of the strongest balance sheets. We want to make sure that the dividend is sized appropriately for the new businesses going forward, and make sure that we're set.
Because honestly, their payout ratio was a little high prior to this, so it's just a good rebalancing.
Ourselves very well to accomplish all of that with where we've set it.
Just to make sure that you have the ability to reinvest without having to dilute.
Yeah, we've said for a while that we would set the dividend at 60 to 65% of earnings, and with the dividend announcement today, we're in that range on the base business. As we move forward and include Narragansett in the forecast and provide the update, we would expect to continue to be, have a dividend in the 60 to 65% payout range.
I prefer less than 50 personally.
Thank you. And then
45 to 50
you
would be
highlighted some
excellent.
of the kind of preview to the analyst day of starting with pro forma 2022 EPS and growing it off there. Is it going to be a 5-year growth that you're looking to provide, and any other color you could share around level of detail that we should expect to get updated at the future analyst day?
Yeah, it'll be a comprehensive update, Ryan. We haven't provided a lot of information since the sale of WPD. We recognize that. We've repositioned the company significantly, and we're gonna, we'll provide a lot of detail on the new PPL, including the growth rate and the duration of the growth rate. So we'll hold all of that for now until we get there, but you should expect a detailed update at that time.
Okay, appreciate the color. Thank you.
The next question comes from Greg Orrill of UBS. Please go ahead.
Yeah, thank you. Good morning. Regarding the dividend, assuming Narragansett Electric closes, when would you provide that new
Investor
level?
Day?
Would that be in the closing or at the analyst day or
Analyst Day?
Yeah, so we would provide an update on that at the Investor Day, based on the current schedule, which would support a March closing, as we've been saying. We would then target to have the Investor Day within a few weeks of closing, and so that potentially could put the second quarter dividend in play for the that increase.
Okay, thank you.
The next question comes from Anthony Crowdwell of Mizuho. Please go ahead.
Hey,
good morning.
Hey.
Thanks for taking my question. Just hopefully two quick
Afternoon.
ones. Just not specific to Narragansett. I know you don't want to talk about the approval process there, but just it's my first transaction in Rhode Island. What's the process if a merger gets declined? Is there a refiling process, or can a company appeal to a higher court?
So there is an appeal process, Anthony. Certainly we're focused on getting the approval done. It really depends on what would be in the order. So it's really hard to to predict, what our next steps would be. Could potentially be cured
Well,
via refiling.
it's always the same time.
And we also have the option
My
to
time.
appeal, but
Are you on the East Coast?
really speculating at this point. We're hopeful that we've met.
It should be like
we've met the standard
6 there right now, right?
We're hopeful that that decision will come out in our favor when it comes out.
Do you know what court the appeal takes place in? Or is it with the same regulator?
I'm not sure about that, Anthony.
Okay, and then if I could just pivot, probably off of Michael's question earlier on Kentucky.
London.
Just,
so that's what I was gonna say. Is like either the East Coast or further east than that. London.
The growth in Kentucky
makes sense
from this level. I mean, just if you could maybe give some clarity on that.
Yeah. So what is it there like?
Yeah, we're
10?
not providing really growth
11
for any parts of the business at this point, but we will provide full updates on all of that on the Investor Day. And to Joe's point, we recognize that we've been in this kind of point between.
Yeah, because that's closer to when I would eat dinner myself anyway.
Without providing a lot of financial detail, and we commit to doing that on the Investor Day, but we're not ready to do that today.
Great. Thanks for taking my question, Vince.
Thanks, Anthony.
This concludes our question and answer session. I would like to turn the conference back over to Vince Sorgi for any closing remarks.
Thanks, and just want to thank everybody for joining us this morning. We certainly look forward to introducing the new PPL to investors.
Yeah, I generally eat late too.
We remain very confident, as we've talked a little bit today, that our strategic.
I ate breakfast before I started streaming.
Will deliver long-term value for our share owners. We do see robust capital investment opportunities going forward to deliver the clean energy future. That investment will fuel competitive earnings and dividend growth going forward. And we believe we can deliver that clean energy future in a way that's affordable for our customers with no equity needs in the foreseeable future, given the strength of our balance sheet. So again, we look forward to seeing you all at the Investor Day and providing all the details that I know you're looking for the new PPL. Thanks, everybody.
Right. Well, still 2 years left to do on the numbers. I got a little bit of a slower start, and well, their initial statements wasn't the longest call. But whatever. Kind of talk about some of the other stuff. So I mean, as I had said at the start of the stream, that I kind of see this company as a potential acquisition target. This concept was actually first brought to my attention by another YouTuber, PPC Ian, who had done some research and found the different changeover between executives and members of the board between PPL and Southern Company, and I thought that was really interesting. And at the time, I was a Southern Company investor, so I was kind of like, that's really an interesting thought. And eventually I did invest in this company as well. And well, I'm no longer a Southern Company investor because that company eventually did take off and provided pretty solid returns. I did eventually take up a position in this, and that's been kind of a bumpy road for the while. But either way, I've been kind of waiting to see how these deals go through, because the idea that Southern Company was going to acquire them was based on the idea that they would be removing their UK business, because Southern Company is a much larger utility company, and as a result has to kowtow. Has to kowtow to the regulatory authorities a little bit differently. So either way, we're kind of so the whole investment thesis is kind of based on seeing whether or not they actually become acquired after removing the UK business, which has only really recently happened. So there's still a decent amount of time to be had with that. Whether or not they wanted to include having the the Narragansett acquisition as well is kind of a random addition. It doesn't necessarily have too much to do with that. In fact, in some ways, you could say that that decreases the chance that that's going to occur, because that just makes them an even larger company for Southern to try to acquire. But basically, I'm planning to hold them for probably, I'd say maybe the rest of the year, to see whether or not that deal goes through, and then beyond that, I'll probably sell them off. It's just kind of like an optionality on that deal. These numbers are, like, they have them reverse negatives like so many times, it's kind of confusing me. 1130 is the end number it's supposed to get to, but okay, I got it right. Jeez, so many double negatives in the income statement, it can be tricky to read them all correctly there. And I was trying to talk while I did it, so that didn't help. But yeah, so this investment, like I said, I've technically held it for about a year and a half already, or a year and a half in weighted dollar terms anyway. So it's been not exactly the greatest investment so far, but if it does get acquired, I do suspect that it would be done so at like a pretty significant premium to its market value at the time. So as long as you build a decent cash cost basis on it before it occurs, then that should provide a pretty decent return, as well as the dividends in the meantime. And definitely have collected a decent amount of dividends. So it's a small portion of the portfolio, definitely not very high expected returns on it. And if other opportunities come, I would definitely ditch it for those opportunities. But as of yet, that's not necessarily the situation. Okay. Purchase, issuance. Yeah, some of those analysts there in the last few questions were really questioning, it seemed like, whether or not the deal was likely to go through. That's one part I did kind of mention while I was doing the 5-year trend, that I think it's basically a for sure deal at this point. Not because it really is for sure, but they technically could turn around this week and say no, but they've had like a dozen or so special little date milestones for them to make specific types of regulatory complaints, and they've made none of those complaints this entire time. So it seems weird that they would make no complaints all the way up to the very last minute and then suddenly say no to the deal. So I agree with the executive management that it's basically as close to a done deal as possible. And it does seem strange, as several of the people had kind of pointed out, that they would be cutting their dividend to supposedly raise it again once the deal is closed, if they're so certain that the deal is going to close, because supposedly they're doing this just in case. And it's like, well, read between the lines, and the real truth is that they just want to rebase the dividend. that's just it. It doesn't need to be something crazy or complicated. They have pretty high payout ratio. They're making a big disruption to the business. They're hoping to make some further growth. And then, like I also said, they perhaps want to see themselves as an acquisition target. And if you have high dividend payment expectations to your shareholders, well, then that makes a higher dividend and payment expectation for the new shareholders that would be buying up your shares, which means the opportunity cost for them to purchase the company is even higher. So if the current shareholders can get used to a lower dividend before being traded over to a company that has a lower dividend, then the new company isn't faced with as much difficulty making that changeover. So that's just one way that I'm kind of looking at it. And high dividends are great, but they're only great if you can sustain them basically forever. Uh, if there's like any real doubt in that, then you might as well just cut it, or trim it. It's like dividends are fantastic, but only as much as can be paid. If you're paying more than can be paid, well, then you're just going to eventually have to do something later on that the shareholders won't. So I'm always fine with cutting a dividend as long as the revenues are theoretically there. So let me see. There we go. These last couple balance sheets are a little special pain in the neck because it includes the previous section of the business that they split off, the nuclear utility business that they had. This was not as successful of a divestiture as this recent one looks to be, though. Right, one more year to go. Okay. Is cost of sale, SG&A. I'm gonna have to do with the double, triple negatives again. Here we go. Let's see, okay, what did I have to do last time? It was negative 28, positive 6. Try to see if I can just probably okay, positive 26, negative 28. Hopefully this gets us the correct result because I do not want to have to like think through the double, triple negatives. These last 2-year income statements are like so annoyingly constructed. Income taxes, and this was a negative 38, positive 42. 38, positive 942. Okay. 26. Okay, cool. Simple. All right, now the last cash flow statement. Okay, it's looking relatively simple. Capital expenditures. Okay, I didn't have these lines in previously, but oops. Oops. This all the way over here. There we go. Debt and equity issuance. Payments to equity. All right, now the last balance sheet. Cash and equivalents. No short-term investments, receivables, customer and other inventories. They're current, including restricted cash, unbilled revenues, prepayments, deferred taxes, price management, regulatory assets. A bunch of random stuff. Property, plant, and equipment. Less depreciation, goodwill, intangible assets, other assets, including regulatory assets, price management assets, and other non-current. Okay, final liabilities, including interest, payables, taxes, dividend, price management, regulatory liabilities. So many line items. Debt, deferred income taxes, other liability, all right, and the final equity statement. Common stock, paid in capital, retained earnings, accumulated other, and non-controlling interests. All right. So there's all 10 of our years. That only took forever. Let's go take a look. Sales to capital ratio. So as I said, with the 5-year trend before for 2020, you can see that they kind of had this kind of stable lower to mid 20s kind of range, and in the few years even prior to that, it was more in the mid range of the 20s as it was. And then in the 2 years before they had divested the other section of their business, they were at a little bit more of a higher range, a little bit closer to the industrial average, or even exceeding the industrial average. So as I was saying, with 2021, with them having divested the UK section of their business, that leaves them with a relatively lower capital base to the revenues they currently have, though they're about to divest some of those revenues and switch them off with other ones. So whether or not the revenue switchover and the capital base switchover is going to end up with a higher sales capital ratio is essentially part of the argument. I'm feeling relatively optimistic on that, thinking that they probably will end up with a sales capital ratio north of 0.3, maybe closer to the industrial average of like around 0.35 as it currently stands. We'll see where we get to with the projections. Overall, they typically trade in the teens as far as a PE ratio goes, with a few exceptions of them trading closer to 20 and some of them trading closer to 10, but typically it's in this kind of mid-range. The average over the entire period, not including the negative number they're currently in, is around 16. That's pretty typical. It's actually incredibly stable. Most companies have a little bit more variability as far as that goes. Total shareholders equity has barely moved really over the entire 10-year period, partially because of so much weird changeovers in the way that they're running the business and which sections they're acquiring or divesting at various points. But considering the stability of their shareholders equity in dollar terms, their overall liabilities have changed dramatically. had $33 billion in liabilities 10 years ago, and now they only have $19.5 billion in liabilities. So if you're thinking about equity relative to the liabilities, then they have increased dramatically as they've essentially paid down a huge amount of those liabilities. That has come at the cost of assets. They used to have $42 to $43 billion of assets, and now it's $33 billion of assets. So they lost about $10 billion in assets. But the trade-off of that is that they lost about $14 billion in liabilities. So, it's been a weird scaling down process essentially for this company over the last 10 years, but it's been a relatively successful scaling down, I would argue. Which just goes to show things that I've argued with people many times before, that growth is not the only way for a business to succeed. Sometimes the best way for an equity share to succeed is actually for the company to gracefully decline, so to speak, and have management that has that concept in mind and isn't trying to eke out bigger sales or larger market share just for the sake of their own pride or something like that, because they typically throw good money after bad to do so. So their overall, their balance sheet position, I'm pretty satisfied with the improvement of it, and they do have $3.5 billion in cash on their current $33 billion asset balance sheet. So they do have a decent amount of optionality with that, though obviously, as they discussed in the call, most of that money is earmarked for various plans, be it the closing of the acquisition, further capital expenditure plans over the next several years as they plan to put themselves in a position to improve their credit and regulatory positioning, as well as share buybacks to improve their equity position even further, on top of the fact that they do have to decrease their operating margins to a certain degree, as we've discussed. Returns on equity are relatively stable, as typically happens to be with utility companies, as they were discussing. A large part of the way that the regulatory operation is managed in the United States does come down to managing the allowable rates of return on equity that can be had for these types of companies. So that's not too surprising to see that they have this kind of stable return on equity. It comes down to buying into these companies at the right time and not just really buying like the right companies per se. It's not that like one company is going to perform some outrageously better than the others, though there is some exceptions in that case. And when it comes to regulated utilities, it's usually that most of the companies are pretty similar in a large part, and you just have to buy them at the right time when they were thought to be very dissimilar, but they had the opportunity to return. But either way out. So over a longer period of time, makes more sense to look at over the returns on invested capital. I think we'll use a 9-year rolling average, and we get kind of 6 to 7% for the returns on invested capital, with a 10 to 11% for the return on equity. I didn't say it, but for the sales to capital ratio, I'm actually probably going to use the 1-year base, since it is closest to what I think they're going to do in the future. And then moving back up towards the cash flow statement again, you can see that over the entire time frame they had, the entire 10-year time frame, they had $16.7 or $16.8 billion of cash flow that they could have paid out to their shareholders. The vast majority of that showing up at the sale of the UK business right here in this year, which is interesting to see. And the total amount that they did pay out to their shareholders over that period is $6.4 billion. So they definitely haven't overpaid their shareholders. Even if we were to completely discount that 1 year and just look at the rest of it, we would have $6.5 billion for the 9 years, and the total payout that they had was 4.2. So even then they still weren't overpaying their shareholders. So partially on the back that they're constantly diluting their shareholders' equity almost as much as their dividends in several of the years. So they pay out significant dividends, but that's kind of counteracted in a large part. Though with their recent share buybacks and the expectation of more share buybacks in the current near future, perhaps that is about to rebalance itself, and the equity investors getting their due, which is part of the reason, like I said, I don't necessarily think that the current situation is as bad as the market's kind of treating it. You can see that their margins, like I said, they've generally had pretty strong margins in the last several years, and pretty low margins before they had divested the other sections of business. So they had improved their business by doing that, but it had come at the cost of their sales capital efficiencies. So they lost revenues, they lost sales capital efficiencies, and they gained margins. It's like, frankly, you really only want to try to lose only one of the two and still kind of remain strong in 2 of the 3 if you can. So that's why I personally thought that wasn't necessarily a great deal. So if the current deal improves their sales capital ratio while perhaps lowering their margins a little bit, I think that might be a decent trade-off. but we'll see. I'm curious to see what it is, the 9-year rolling average with this, if it includes the negative 25%. A 9-year average, it gets us to 14%. So that actually might be a decent base year number to use, depending on things. Like I said, I will see what I come up with when we look at their numbers. Maybe 12 is even better, which is the 5-year number, partially just because this really high number and that really high negative number balance each other out, so you end up kind of getting an average of only a few numbers left over. But anyway, so we will take a look at some of the other statements before, as we get into the projections for things. As I said, don't pay too close attention to this. We have to do a lot of adjustments for things. I wanted to look a little more closely at the income statement line that they have for this most recent year, because the way I have it broken up here kind of like recategorizes all the numbers into specific categories that I like to read them by, but I actually want to look at their categories so that we can think about how we want to project for the future. In the current year, the income from continuing operations, so this is not counting the divestiture, they had $18 million as a profit, which isn't very good. But so let's just take the 18 million. 18 million. My calculator over here. I'm not going to reveal just yet because I have other numbers on it already. So we have the $18 million with the current situation. Now that includes all these current line items right here. Their income taxes is a disproportionately high number for the current year, but it's not super disproportionately high. So I'm going to argue that this 500 on a normalized basis, we can assume it returns to possibly around 400, which means on top of the 18 million, we can add perhaps another $100 million in cost savings that we had on the back of lowering the income tax rate a little bit. And then I also believe we can eliminate these taxes and other income, or at least half of them on net, on the back that a decent amount of them come from special taxes having to do with the UK section of their business. So we'll add another 100 million back, essentially saying that 50% of that disappears. Now, I also think that we can eliminate perhaps 20% of the depreciation here because of the divestiture of certain assets on the business. Now they're going to purchase different assets, and those assets are going to have a different set of depreciation rules, but it's also going to reset for those assets. So it's not going to be anything in year one for those immediate numbers, and then the straight line is going to begin in the following process after that. So I'm essentially going to add back another 200 million to the income that we're trying to build a normalized income, essentially. So that's basically what I'm doing here, is thinking basically off of these revenues, what type of normalized number can I expect for an income? And so that's what I'm doing. We're adding back, like I said, we added back 100 million for income taxes, another 100 million for these other taxes by cutting it in half, adding back another 200 million from the depreciation line. And then operations and maintenance, I'm willing to say that we can cut perhaps another close to 10%. I'm really just going to take 1/8 off because it's the easiest way to kind of do the numbers here, because 800 is half of that and 400 is a quarter of that, and so 1/8 is 200. So I'm going to take 200 off, and that's technically an eighth, so that's about 12%. But whatever, we're just kind of trying to come up with some rough numbers. This is nothing too fancy that we're trying to do here. And we're going to leave all the other categories alone because those are actually likely to go up over the near future. So I've added all those numbers to this calculator here, which has some other numbers in here. So that's part of the reason already, and that's part of the reason I didn't want to bring it over immediately. But I'm going to bring it over here for the moment because I'm going to show you. This is, like I said, a normalized net income that we think we could achieve on the backs of specifically these revenues, which are the revenues that are left over after removal of the UK revenues. Now I'm going to pull up this sheet over here, which is the Narragansett Electric statement that National Grid has released most recently, which gives us the numbers for their most recent year. They have $1.5 billion of revenue. So if we add these revenues to PPL's basis and we add all these expenses over as well, then we would essentially be adding over this net income line right here. This net income line, we're going to go ahead and add that to our calculation as well. which I already have. Like I said, those numbers are sort of already in here to a degree. So we already added in the net income line, and now I've also added back other specific things. We left the taxes in the tax expense in because, like I said, we already did a trim on the other taxes, so we're going to leave this expected tax rate in. I removed this other net income line because that money National Grid might keep themselves. I don't know what that income is. We're going to assume it has nothing to do with the business. So I didn't include this. I subtracted that out. I subtracted out the interests because we're going to have our own capital structure and our own debt situation. So I subtracted out the interests. I subtracted out the other taxes because those ones I think are not directly associated with it. I subtracted out the depreciation because we have our own depreciation situation. And then I subtracted out 100 million worth of the operations and maintenance, which is basically cost savings that I think they can achieve by the combination of the business. And by adding all those things together, that's basically what I have in this calculator here. I come up with $1.3 billion of potential net income for PPL. Now, this is what I'm going to consider a pretty close to like a best case scenario. Let's be clear. This is a rosy picture. This is nothing meant to be like a super, oh wow, yeah, this is super obvious that they can achieve this. This should be considered a pretty rosy picture for them. Now, like I said, we're going to assume that they get these revenues, $1.5 billion in revenues on top of their 5.7 would get you 7.2 to 7.3 billion dollars in revenues. So we do have to assume that part is caked in, and then we're going to build our net income margin up to this number essentially. Now let's see. Like I said, this is a best case scenario. And the problem with this is, like, as I've mentioned with other valuations of mine, is that if I try to have a number reach a certain base level within the first year here, that means I have to leave the same cogger in. So that's one problem I have here, is that 10% is maybe more than is necessary if you're assuming that it's going to get to that revenue, but then also still have to grow in the years after that. It might be to like just to those numbers in this year and then 5% each year after that. So it's a little bit tricky to actually do 1350. Hold on, I'm gonna let's just take $7.3 billion and assume that it grows at 5% for 4 years. That would get you 8.8 to 8.9 billion dollars. So that's actually going to be sort of our number that we're going to use. 8.8, 8.9, that's 9%. Now, however, that undershoots these more recent years. So in that case, I actually will go with the 10%. I don't want to determine how much of an overshoot that actually was, but I guess I'm going to say that that's a fair overshoot. Because if we're saying 8.9 is what should be here, that's like 400 million extra, maybe 300 million extra, 700 million, 800 million extra, and then you can say that that's balanced out by the amount that's being declined right here. So it's a relatively balanced out number essentially if we use 10%, I think. Now, as far as the worst case scenario, that's the part that negative 5% is probably way too low of a number, considering the worst case scenario is that they don't get the deal and that they probably then grow at like 5% per year as a result after that, because that's where they are, which I guess we'll put 5% in, but so I would say 5 to 10% is probably the expectation off of their revenues currently. We'll actually use maybe 3% on the assumption that 5% is their base rate, but we can also assume that they have lawsuits that interfere with that. So 3 to 10% is probably our best case revenue, or not best case, our assumptive revenue range to use for them. As far as, I'll use 9 for the analyst number because I do think that that's relatively in line with what's expected. Now actually we'll just go ahead and use 10 since like I said, we assume that the deal is going to go through, and we'll just adjust probabilities accordingly. We're going to go down to debt to equity ratios. Now we need to do the margins first while I'm still remembering them, because like I said, 1350s, oh wow, how nice. It actually kind of ended up relatively close to what we were projecting already. 15%. So 15% as a best case margin is actually relatively in line. It's funny, I kind of had said that I thought that might be as good of a best case it could be, but I didn't actually expect that to be quite so accurate. Now, as far as a worst case number, maybe like half that, but it's not going to be 5%, I would say. And then expected value, we can probably just use somewhere between the median and the fourth case value. Maybe 12% is probably fine. Gets us an expected value of 11.5. It's that maybe a little bit lower. Maybe 10 or 11 is actually acceptable. I don't know. It depends on what we do with the probabilities, I suppose. Mm, 17. All right, so now let's deal with the debt to equity ratio. That part's going to need to be changed pretty significantly. What did I come up with when I was figuring my numbers around a little bit last night? Okay, so with $19.2 billion market cap, we could assume that there's a pretty dramatic drop in the market cap, especially if the deal wasn't to go through, for example. Easily 1/3 is utility companies, so 50% when it's already at depressed values is less likely, I think. So perhaps moving down to like $15 billion, which would put them relatively close to where their debt would be if they were to also take on a pretty significant increase in their debt. So you could see them getting to 100% or even a little bit past it in a worst case scenario. Their current being 77%, which last year they were at 120% or 130% or so. So as I said, it has been a pretty dramatic improvement in their debt to equity ratio. Let's see, as far as a best case scenario, 0% is definitely way too low. It's probably something more like in the range of 15%, depending on where that leaves the expected value. 5% on the analyst number. See, that leaves the expected value at 56. That's perhaps reasonable. It could maybe be a little bit higher. So that leaves expected value at 63. And then we'll leave the analyst on the best case scenario, partially because of that's how I'm pricing in my expectations about potential acquisition targeting. Okay, now for the sales capital ratio, we got to bring that down pretty significantly. Like I said, I do think that they are going to be able to push up north of the 0.3 mark without too much difficulty, though where it would end up over the long run is a question. Let's just kind of use that as a midpoint and see what that kind of gets us. 0.35. Or if I put 0.45 in, that gets us an expected value of 0.32. I think they could easily do 0.32 in the next year, to be honest. Let's see if we push this to 0.5, where does that meet? Median to 0.33. Okay, let's just bring that back down to 0.45 and instead bring the basis to 0.2. That brings it still to 0.33. That doesn't really change anything. Okay, actually, we'll leave it like that. The expected value of 62. Okay, so it does leave some room because I do want to shift the probabilities a little bit. Okay. need to take a look at the interest and tax rate. There's no huge problems there. See, okay, so I probably need to shift the sales to capital ratio up a little bit further to adjust for the fact that it's trying to make it pay for the revenues. I think that's part of the issue of why the number's coming in a little bit lower than it probably would otherwise. I'm probably gonna have to shift the sales capital ratio up because I'm thinking about more of my perpetual sales capital ratio, but it needs to also take into account the fact that the sales growth they're about to get is essentially free. So I can't do it too much. It's just looking like the value is just a little rougher than one might have hoped. So, for them. The low sales to capital ratio, it's like the higher debt levels are dangerous for them, but at the same time it makes the growth relatively cheap for them. So that's the thing. Let's see, my current expected debt to equity ratio came in at 58 to 59. Let's see, so maybe not too much else other than the default risks. That might be about it. Okay, so let's take a look at perpetual debt levels. I would assume 0% default risk in the best case scenario, but beyond that, then we'll use the charted levels. See, am I getting you something? I'm definitely surprised by how low it's coming in, but hey, I mean, sometimes it just comes in the way it is. If it always came in the way you expected it to be, well, then it would be unlikely you were doing real valuation. You would instead just probably be feeding your biases. But either way, it still makes me wonder if I'm simply just forgetting something. The dramatic changeover. But sometimes you just gotta go with what the calculation tells you. You see, I think that is about it. 1,300 expected income comes in about 1,000. Yeah, it's just rough. But that's based off of the way I'm projecting the margins. I could be entirely off on the way I'm projecting the margins. So who knows? Maybe I am being way off on that. But I don't know. I guess that's gonna just have to be what it is. Well, we'll hold confident with it, I suppose. That's gonna be it for PPL Corporation, Pennsylvania Power and Lights, public regulated utility. U.S. Treasury selling for 1.927%. Mature market equity risk premium I get is 5.11%, which gets me to a discount rate for the company of 6.81%. Relatively low discount rate coming from relatively low unlevered beta for their industry. They do have a dividend currently of 3.07% after the currently cut rate, though supposedly they're going to be rebasing that again in the future. 5 years ago, they had sales of $7.5 billion. In the current year, they had sales of $5.7 billion, which comes in at a 5% decline per year for the last 5 years. Sales to capital ratio For the last year, it was 0.27 relative to industrial expectations for utility companies of 0.35. That's 35 cents of sales earned for every dollar of capital-based investment that they make. That's essentially what this metric is. Returns invested capital for the last 9 years on average has come in at 6.49%, and they have a debt to equity ratio currently of 77 to 78% or so. Default risk of around 1% in the most recent year. R&D adjusted profit margins of 12.47% for the last 9 years on average, relative to industrial expectations of 17%. So they have relatively low sales to capital ratio and a relatively low profit margin. So not a super high qualitative setup to be looking at on net, but the expectation is hopefully that they would improve those metrics over time. Profit loss in the most recent year, partially due to the divestment of their business. They're currently selling for $26.10. The probability distribution that we're using for the company is pretty heavily tilted towards the median and optimistic ends of the model. And with that, we end up with a sales distribution of anywhere from $6.7 billion to $9.3 billion in the 5-year forward period, and a worst to best case scenario situation. On an expected basis, we come up with $8.2 billion, which would be 7.29% sales growth per year for the next 5 years. This is based on the assumption that they close their Narragansett acquisition, and we gave them a boost to their sales to capital ratio, partially on the assumption that they're going to improve the sales to capital ratio organically after that close, but as well as to give them the fact that the acquisition is essentially closed and the cash is being dealt with on net. Returns on invested capital projection we have is 4.36%, so it is a relative decline, which is not very great to see, not a very high qualitative factor to look at as well. Debt to equity ratio expectations we do assume on an expected value of around 58 to 59% in the 5-year forward period. Overall, our default risk expectations around 1.46% per year, which is a little bit higher than you'd like to see. Anything over 1 gets a little bit more uncomfortable because it is a per year default risk metric. And our profit margin expectations, we have a distribution of anywhere from 8% to 15% in the best case scenario, which gets us a 12.29% distribution overall, which gets us a profit distribution itself of anywhere from $500 million to $1.4 billion in the 5-year forward period, on expectation about $1 billion or so, which gets us a present value using the discount rate that we're using of $17.89 or $17.89, my bad, which would be 31 to 32% lower than the current share price, which gets us also 5-year forward value targets, unadjusted for all the dividends that they would pay out during the period, of $9.24 in the worst case scenario to possibly $43.55 in the best case scenario, which on an expected basis would get us $24.87, which compared to the current share price implies a return of just under -1% per year for the next 5 years. So very unenthusing, is to say the least. Our short-term pricing metrics, which uses a regression process against market fundamentals, as well as the S&P 500, to come up with expected multiples and expected pricing for the company based off those multiples, would get us a suggested price of $14, which is pretty rough, but it's also relatively in line with my valuation, which is always interesting to see. These things very often disagree with each other, so it's always interesting when I think a company is pretty rough and then this also agrees. My value score comes up with 0.12, which is pretty rough, and like I said, this is a company that I currently hold. My previous valuation was saying that it was about fair value. I'm pretty shocked to see this change over with just the 1-year change of numbers, but I think that has to do with a dramatic change in the equity risk premium, as well as the fact that they have a really low sales to capital ratio means that while lowering their debt ratios makes their investors feel more comfortable, it's actually probably not good for their business, because like I said, the sales to capital ratio means that for every $1 that they invest in the company capital structure, 27 cents of revenue is what they get. That sucks. Like, that's not very good at all. That's not what you want. And then out of those 27 cents, they get to keep about 12 to 13% of the 27 cents. That's what these metrics mean, essentially. So, you know, it's not very good at all, which basically means if you're going to have to invest $1 to get 27 cents, wouldn't you like to be able to make the vast majority of that dollar be debt instead of equity? That's kind of how investment works. It's like if you have a low sales to capital ratio, you want to be able to have a high profit margin and then also be able to sustain a high debt to equity ratio, because the high debt to equity ratio will counteract the low sales to capital ratio, and then the high profit margin will make it so that you can pay for your debt. So, I mean, that's basically the logical triangle, so to speak, of this valuation. Yeah, and see, that's one of the reasons why they're focusing on lowering their debt so much, is to try to get a better rate as well. That's a huge factor for them. That's one of the reasons they're focusing on it, but it's not very great for the valuation model. So I don't know. It looks like I'm going to have to be selling out of this company, even though, like I said, I was really hoping to kind of wait and see about a special situation on as a potential acquisition target, and I was basically looking to wait 1 to 2 quarters, maybe in through the rest of the year, but not gonna be doing that probably now. So no, I've had this mic for a while. I don't know, I adjust things every once in a while. I think the last time I adjusted the settings on my mic was like a week or 2 ago though, so I don't know. Does it sound weird? Is it coming in bad? That's one other thing to know. So anyway, let's see. Like I said, the start of the stream, it's looking like perhaps Jeffries on Friday. Okay, good. Gotta be sure. You never can be sure when somebody says something about mics. It's like either good or bad. But yeah, no, I played with the settings like a week or 2 ago. I'm always trying to fix some of it, because I mean, it definitely never sounded super great to me, and I was also always trying to like figure out ways to make it sound better when the earnings calls are on. I really want to try to get my hands on a like a sound gating effect. I know I used to do some sound production, so I'm like familiar with the different types of effects that you can do, but I want to get a type of sound gating effect so that I can have my voice gate in at a higher volume whenever I speak over different sound sources, but I haven't found a good way to do that with my streaming software. But either way, so in the meantime, I was basically trying to make it so that my voice came in clearly when some CEOs were speaking. But the problem with that is that some CEOs have like kind of these high timid voices, and then other people have like really deep thick voices, and then the sound quality of their conference, devices is usually pretty all over the place as well. So it can be pretty hard to do that. Yeah, no, I mean, like I said, I know of the techniques to do it. I just don't know how to do it with my specific software. Yeah, I'm using Streamlabs, and I'm sure there's probably a way to like download special effects software with that, but I just haven't really gotten to take the time to do that too much yet. So in the meantime, I was just trying to use some of the basic effects that are already built into Streamlabs. But yeah. So either way, I gotta go, so that's gonna do it for us today. Like I said, Friday it's looking like maybe Jeffries, even though I've said that several times now. AT&T is the only one on our list that has the 10K out currently, and I'm waiting on that one to do until after I get the Discovery 10K as well. So unless something else on the list shows up, it'll be probably Jeffries on Friday. Like I also said at the start of the stream, I think I'm probably going to be buying into a small position of Facebook tomorrow. That is just, I think, look, it's irresistible at this point. Though we are definitely going to be starting small and averaging in. I would rather be sad that I didn't jump in with both feet than be sad a year later when it hasn't moved. So we'll see. but yeah, so I will catch you all on Friday. Please like, follow, share, subscribe, all the things, all my social media in the comments. If you enjoy content like this, please share it with other people who do. We are constantly trying to grow the channel. I know the 2 people who are here already are already subscribed that I can see, though I'm pretty sure there's at least 1 other person watching. So if you're not subscribed, please subscribe and please like and please share. I will